Would you like to know how to get started trading futures without having a large account and without taking large risks? Hi, I'm Dan Scarr, the developer of Scarr Visual Trading. In this video, I will show you how to do just that by trading what are known as carrying charge spreads. I'll also show you the tools that I created and put online to help you find and evaluate these and other kinds of trades. Though it's a subscription site, non-subscribers can still use the tools but are limited to crude oil and soybeans. The term carrying charges, or cost of carry, refers to all the costs associated with storing a commodity. These include the actual storage costs, insurance, and financing. So how can the risk be limited? That's what I want to show you now in detail. But first I need to credit Courtney Smith for his book Commodity Spreads, where I learned this. Suppose March corn is trading at 400 cents per bushel and the carrying charges from March to May are 25 cents per bushel. Are there any constraints on the price of the May contract? The answer is yes. It would be very unusual for the price of the May contract to be any higher than the price of the March contract plus the carrying charges. If this were to occur, then traders that could store the product would lock in those prices by buying the March contract and selling the May contract. Then they would take delivery in March at the price specified by the March contract, store until May, and then deliver at the price specified by the May contract. Since the difference in prices is greater than the cost of storage, the trader locks in a risk-free profit. These trades put upward pressure on the March contract while putting downward pressure on the May contract, eventually reducing the premium paid for the May contract to less than the carrying charges. Now there's one risk that we have ignored. That's the risk that the cost of carry could go up, but that's a relatively small risk. In what type of market conditions are we likely to find the premium of a back month over the front month approaching the full value of the carrying charges, known as full carry? Normally the agricultural markets will pay a premium for nearby back months. This reflects the net desire of the market to have some of the commodity in storage. But in bull markets, those that need the commodity soon will bid up the front month. As the premium of the back month over the front month declines, the benefit of storing the commodity also declines, so more producers will bring the commodity to market rather than storing it. Markets approaching full carry are therefore more likely to be found in flat or bear markets. Now suppose the commodity is not storable. In this case, there's no constraint to how much higher the back month can rise over the front month. This makes spreads involving those commodities inherently more risky. The price relationships between different expirations of a commodity are known as the term structure. We can see these by selecting the Programs tab of the menu, going down to Open Contracts, and selecting Term Structure. These charts display price versus contract, with contract on the horizontal axis and price on the vertical axis. Each month is represented by a different color so that a color will repeat after 1 year. There's a lot of interesting information in these charts. Notice how regular the values are in the currencies. This is because they are easily stored and there are no significant seasonal effects. Looking at the energies, we see obvious seasonal effects in gasoline and heating oil that appear to cancel each other out in Brent crude and crude oil. Looking at the grains, we see both carrying charges and seasonal effects. Now we can also see how the term structure changed in time. From the Programs tab of the menu, go down to Open Contracts and select Charts. These charts display price versus time for the nearest year's worth of open contracts. At the top on the left, we see the commodity selector. The chart is currently showing nearly 10 years of data for Brent crude. If we only want to see the more recent data, we can truncate the series using the selector in the middle. Below the chart are the chart controls. These are controls for the type of chart, the size of the chart, and the thickness of the lines. There are two types of charts. The JPEGs are created on the server and are very fast but are not interactive. The AmCharts charts are created on the browser and are interactive but take longer to load. These are the JPEG charts. Now let's switch to the interactive charts. We can zoom by clicking and dragging with the mouse and unzoom with these buttons. Because we can zoom here, there is no control to truncate the series. This selector with the arrow pointing downward is used to save a chart as an image. Click the type of file that you want. The file will be in your browser downloads. You can right-click on the file to see the directory that it is stored in. If you don't see the file at the bottom, click on Downloads in the browser menu. You can also save a chart so that you can see it updated daily without having to re-enter all the parameters. Below the chart on the left, you will see the controls for doing this. After we hit Save, the chart will appear in the table on the left panel. Notice the legend above the chart shows the values at the date of the cursor location. By clicking entries in the legend, we can toggle curves in the chart. Notice how the term structure flips early in the bull move. On the other hand, if we change the commodity to gasoline, we see there is no flipping of the term structure here. Instead, we see seasonal effects predominating with two groups of curves, the summer months trading above the winter months throughout time. So how do we take advantage of the fact that the back months are normally constrained to be less than the front month plus the carrying charges? We buy what is known as a bull spread, long the front month, short the back month, when it is near full carry. This is called a carrying charge spread. A bull spread profits when the front month goes up relative to the back month. A bull spread loses when the front month goes down relative to the back month. But near full carry, it would be unlikely to move very far in this direction. Now let's look at some spreads. Go to the Programs tab of the menu, go down to Spreads, and select Spread Charts. This is the main charting program. Notice that we can select from 1 to 4 legs, and that each leg is shown in a different color in the controls. Also notice that as we change the commodity and the month, the contracts in the alignment control change accordingly. The alignment control is used to specify how the contracts are aligned to make the spreads. The buttons at the top shift the column below upwards relative to the other columns. The unit move is the value in dollars of an upward move of 1 unit of whatever the commodity's price is quoted in. Do not confuse this with tick value, which is the minimum move allowed. The unit move is equal to the contract size times the units. If we look at crude oil, the contract size is 1,000 barrels. The units are dollars per barrel. And if we multiply those together, the barrels cancel out, leaving us with $1,000. If we look at corn, the contract size is 5,000 bushels. The units are quoted in cents per bushel. When we multiply those together, we get 5,000 cents, which is equal to $50. This means that a 1 cent per bushel change in the price of corn changes the value of the contract by $50. The unit moves are filled in by the program automatically and only have to be changed if you want to chart a contract with a different size than the standard contracts. We can see the unit moves as well as other commodity specifications by going to the Help tab of the menu and selecting Commodities. The unit move is needed to chart spreads with legs that have commodities with different size contracts or use different units. The unit move is used to convert each leg into a dollar value so that they can be combined. On the right, we see the control to select the number of years of spreads to include. The bottom panel shows the outright commodities. Oats on the left axis, corn on the right axis. The top panel shows the spread. Since we're looking for carrying charge spreads, let's switch the second leg to oats. Notice that the range of the spread is much smaller than the range of the outright. This is why spreads can be traded with a much smaller account than the outright and have lower margin requirements. Notice that each year's spread is in a different color and that the colors repeat every 10 years. Here we see that the spread has a nice floor to it. A good way to execute this trade is to put a limit order in at the price you choose. The lower the price you get in at, the better the trade performs. But the probability that your limit order gets filled goes down as your entry price goes down. Once your order gets filled, you might want to put in a limit order to close out the trade at the profit level you decide is appropriate. To help us decide on a profit level, we can shift all these spreads to the same year so we can compare them more easily. We can do this by selecting Stacked Chart from the Study options. The month and day of each data point remain unchanged. Only the year has been changed. We can select the spreads to display from the contract selection box in a number of ways. You can click and drag with the mouse. You can hold down the Shift key and click on the top and bottom choices of the range of your selection. All choices in between will be selected. You can hold down the Control key, the Command key for Apple users, and click on all your selections individually. Click again to deselect any choice. Let's look at the spreads from the last 10 years. We can start all the curves at the same point by normalizing the chart. This will shift each curve vertically so that its value is 0 at the chosen date. If we normalize at the start date we are considering, it becomes easier to judge the outcomes since they all began the trade at 0. Let's start the trade on July 1st, since earlier than that we see some horizontal lines, which indicate low volume and liquidity. Since the first notice day for this spread is the first notice day of the front month, which is February 28th, we will want to exit by February 26th. So let's zoom backwards from February 26th so that we capture only the tradable part of the curves. As you can see, this type of chart makes it easy to see what part of the curves are tradable. We can see that if we set a modest target profit of 2 or 3 cents per bushel, most of the spreads reached that value during the trade. Remember, they all started at 0 because we normalized to 0 at the beginning of the trade on July 1st. You can toggle some of the lines off if there are too many lines to see clearly. These types of charts are also good for seeing seasonal patterns in price and volatility directly. Here we see increases in both price and volatility as the trade approaches expiration. We can make a seasonal from the data by selecting Seasonal Chart from the Study selector. Notice that open spreads are grayed out on the Contract selector because we only want closed spreads to be used to make the seasonal. The seasonal is shown in black. The gray lines are plus and minus 1 standard deviation. This is a measure of the amount of variation in prices amongst the spreads at each point in time. The nearest open spread is shown in blue, and the following year's spread, if trading, is shown in green. Again, let's zoom backwards from February 26th so that we capture only the tradable part of the curves. We see a modest bullish trend, but with a growing variation in the results. We can calculate the results of buying and selling the spreads at predetermined dates by selecting Calculator from the Study selector. The chart at the top is similar to the stacked charts without the price information. Instead of price, the vertical axis identifies the year of each line. This chart is used to show how various years' spreads are laid out during the year. The orange region shows the period of the trade that is selected by these open and close controls. If we change the close to April 1st, we see that the trade interval moves back in time in order to find trade. Let's select July 1st for the open and February 26th for the close. In this table below, each row represents 1 year's spread. The first column shows the contracts. The next columns are the open and closing values of the spread. After that, we have the change in the spread and the change in equity. The change in equity is simply the change in the spread times the unit move. Profits or no change are shown in black. Losses are shown in red. Maximum adverse excursion is the worst equity experienced during the trade, while maximum profitable excursion is the best equity experienced. You should examine each row of the maximum adverse excursion column. This is not how much you lose. This is how much pain you must bear. At the bottom, we have the averages, and below that, we have the number of trades and the percent profitable. Here, we see that the average profit was $201, with slightly less than half the trades being profitable. Our worst equity was being down $650. Of course, we can do better than this because we would not normally enter these trades at some pre-selected date, but would wait until we got the price we wanted or not enter the trade at all. And we could exit the trade with a limit order at our predetermined profit level rather than according to a date. Nevertheless, it gives us an idea about the profitability of the trade. I would suggest starting with a limit order of only 2 or 3 cents per bushel above the entry price to close out the trade. And if hit and there is still plenty of time left in the spread, you should put in another limit order to enter the trade again. As the time left in the trade decreases, you should consider lowering your entry price. Once you gain confidence with this, you can try to catch larger moves by adding a second spread with a higher exit price. And to lessen risk, you can enter this spread at a lower price than the first position. This type of trading is known as scale trading and works great with trades where the risk is limited. It's based on the same principles as dollar cost averaging, and it's something that every trader should know about. Remember, the great advantage of this trade is that you can decide how much risk you want to take by your choice of entry and exit values. If you are anxious to get into the market, it would be better to put in low limit orders in multiple markets rather than a not so low limit order in a single market. Then, when one of them gets filled, you can always close the other orders if you don't have enough spare capital. Now you have the techniques and the tools to get started in the futures market the safest way that I know. I can't recommend a specific broker, but I would recommend a broker who specializes in spreads, at least when you're starting out. Even if you have to pay higher commissions, you'll save money with proper advice and better fills. If you're watching this video in YouTube, you'll see a link to the site below the video. If you have any questions, you can reach me at dan@scartrading.com. Thanks for watching, and good luck.